The Fed has made its decision about its bond buying for now. So how should you decide what to do with your portfolio? Here to talk about that is Kristina Hooper from Allianz. Welcome, Kristina.
Thank you.
All right, so the Fed is going to continue its bond purchases, no taper, so they can't be that thrilled with the state of the economy. What's your view of the economy?
Well, I think actually the Fed certainly sees a lackluster economic recovery, but I think their decision was more prophylactic in nature. I think there's a lot of concern about what's going to happen with the debt, the budget showdown in Washington, D.C., and my sense is that this was much more about preventing or trying to help the economy with a significant headwind as opposed to actual concerns about the economy. I also think another issue, of course, was concern that yields had gone up so much. The Fed had pointed to that tightening of financial conditions is another issue. Now, it hasn't really had any ramifications yet, but again, I think they want to be preventative and try to take down yields, particularly mortgage rates, in order to ensure that the economic recovery doesn't in some way get diverted or taken off track.
So you're talking about the Fed and Congress. What about good old fundamentals? We have third quarter earnings season coming up. What are your expectations for that? And is the stock market right now overvalued or undervalued?
Well, our view is that we're probably going to continue to see the kind of subpar growth that we've seen, and that is typical of an economy that is deleveraging. So we don't expect any kind of great earnings season for sure, although we'll probably see the same pattern we've seen in past quarters where companies have very lackluster top-line growth, but are able to eke out profits for the most part because they've cut costs so much.
Is there a sector or group of stocks or individual stock that you like in this particular scenario that you're laying out?
Well, I would say dividend-paying stocks make a lot of sense because they really do offer that real positive return that is needed in an environment of financial repression.
And in terms of allocating assets, let's start with stocks versus bonds. What would you recommend right now? I know everyone has their own case depending on how old they are, but in general, how should a person allocate stocks versus bonds? And then we'll get into international versus domestic.
Well, we're very positive on equities right now, not because they're necessarily very undervalued. They're probably fairly valued to slightly undervalued in the U.S. Globally, they're attractively valued for sure. So we would be very long equities. Short on bonds. Within the fixed income space, we are very focused on spread product, short duration.
And what about international stocks and international bonds? What's your view of both Europe as well as the emerging markets?
Well, Europe certainly has upside potential. We've seen an economy that has finally climbed out of recession and does have the potential to surprise, although it is very much a delicate recovery. So the valuations are very attractive in Europe right now, and there could be some real opportunities there. Now, shifting over to the emerging markets.
They were not a lot of fun this summer.
They were not a lot of fun, but that was driven by the Fed. And if you look historically, that has been the case, that Fed movements and Fed decisions really have impacted emerging markets equities. And we saw those capital outflows this summer. We're likely to see very much a stay of execution over the next few months. We don't anticipate the Fed will start tapering until year end. So we'll likely see, in the short term, emerging market stocks doing okay.
All right. Thanks a lot, Kristina Hooper.
Thank you so much.
And thank you for watching The Street.